You can't ignore the PMI numbers that came out of China just last year and today. I think it's a consequence of a broader trade dispute. And I mean, we all talk about the trade war between China and the US, but this is really something that started maybe 8 to 10 years ago. We went into a continuation of this war in 2018, and we're seeing the same kind of patterns in the PMIs between services and manufacturing. So I wouldn't call this a surprise. I think it's expected that manufacturing would enter a recession when you have a trade war, and the industrial metals would also go into a recession. But the service PMIs have held up. And this was something that we saw also in the early stages of the trade war, which I regard as happening 2010 to 2015. So we're seeing the same pattern. Now, there are differences between the trade war then and the trade war now. And a lot of it, the devil is in the details, but I think there are clues in how we can trade and how we can navigate these markets.
And where are you looking for those clues?
It really in the details. Now, one of the big factors that's missing this time is, of course, QE. We had QE in that period of initial trade war, and that was a cold trade war. What we have today is a hot war. Donald Trump has taken a cold war and turned it into a shooting war. So it's a little bit more public. The reactions are a lot more based on sentiment and on capital flows. And at the same time, we now have the central banks pulling back from QE. So it's going to be a little bit more difficult to navigate this time, but there are ways around it. And one of the basic ways is, to look for assets that have priced it in already, as opposed to assets that still price in status quo, steady as she goes.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.